Hey guys, welcome to another video. We are going to talk about financing options when you go to buy a business, okay? So there's a lot of specifics, and actually there are a lot more resources out there that you can partner, but these are the main ones that I'm going to discuss today. So we've learned already in the past several modules about stocks and real estate that other people's money is a way to leverage and get ahead, right? So just like you're not going to, when you go buy a home, generally speaking, you're not going to just go lay down the full amount and buy the house in cash to go live in. Odds are you're going to finance the vast majority of it. Same thing with a business. You are going to finance it, generally speaking. So let's talk about how this works out on the business acquisition side. So you can obviously use personal funds, and there will probably always be some combination of personal funds that you use. So we have personal lines of credit. We have credit cards. Obviously, you can access. We've discussed how those are typically not the best long-term solution because of extremely high interest rates, but I need to add it on the list. So credit cards, home equity line of credit. So you could take your current home or other investment properties, right? And potentially take a HELOC, a home equity line of credit, or a home equity loan and take out money to get access to capital. You can use cash value life insurance if you have cash value in your life insurance policy. Again, we've talked about S-block, so securities-based line of credit. So lending against your securities portfolio, or like stock and bond portfolio, mutual funds, ETFs, stocks, that type of thing. And then you can also do a 401k loan for up to $50,000 or a portion of your account, right? We've talked about that in past videos, but I thought I'd throw that in there as well. So these are the personal funds you can use. Obviously, if you have cash, then you could do that. You could sell securities to get, free up money to go buy a business, whatever you need to do. So personal funds is on the table. It's an option, okay? Another option is small business loans through the Small Business Administration, SBA loans, as they're commonly called. If it's an existing business, you have a higher likelihood of being approved for a loan because there's revenue, right? It's hard to get a startup loan because that's extremely risky, okay? But if there's an established business, it's got financials, you show them the balance sheet, you show them the revenue, they're much easier to get qualified for. Now, that doesn't mean that it's a totally easy or frustration-free process. Sometimes the process is extremely frustrating, and it can take a while to get approved and get the funding and work through the process. But it's an option that works really well. Now, the way that these work typically are you usually need to put down 10% as a down payment on the business. So if the business is worth $500,000, you need to come up with $50,000, and you could go finance the rest, so $450,000. You could finance that through an SBA loan, and typically it have pretty reasonable interest rates. Again, if it's an established business, it's viewed as lower risk, so you can get typically pretty good rates. SBA, right, partners with banks and other lenders. So you go through the SBA and they direct you to an institution, and then you get the SBA loan through that institution. But typically the rates are lower if you're approved. And then also a lot of times it's a 10-year loan, a 10-year term. Okay, so you're going to be paying back that loan with interest over 10 years, and then you are done. That's how that works. Next option is seller financing. Okay, this can be another good option if you don't have a lot of upfront cash. The seller can actually finance. Essentially, you complete a buy-sell agreement, and you just agree, you come and agree to terms where the business shifts over into your name, and you agree to pay out according to the terms of the seller financing. So usually there's an interest rate involved. And it says, yeah, you're going to make monthly or quarterly or annual payments or whatever for 3 to 5 years at this interest rate, and then the business will be yours free and clear. Okay. Seller financing can be a nice option if that works out well, and if the seller is amenable to it, because there's risk here for the seller, and it mitigates the risk a little bit for the buyer. Typically, these seller financing, they have some type of performance component baked in. So if revenue continues as it has been, then they get the full value. But sometimes if revenue drops off, that can go against the purchase price and end up, the seller can end up getting less money. And so by doing seller financing, the seller shows, hey, I've got confidence that this business will continue to go and grow, and you'll owe me, you'll pay me the full amount. And so as the seller, or as the buyer, you can say, hey, they've got a lot of confidence. They still have skin in the game, so to speak. And so that gives me confidence to go ahead with the purchase and grow it, because they're kind of on the hook too. It's not just like they're done and they're out. Okay. But again, as the seller, that presents risk, right? What if the buyer tanks the company? What if they make some bad decisions and all of a sudden revenue starts going down? Then you're getting less than you asked for, less than you agreed upon for the business. So there's risks on both sides, but seller financing can be good. It can be flexible as long as you guys agree to terms, then it can work out. And yeah, it's worked successfully for a lot of different people. And then the last two we've talked about again in other areas, but there you can get together with partners and you can get investors as well. So as partners, you might say, hey, I'm going to come in, I'm going to operate the business. You come in as a capital partner, or maybe both of you come in and join money together and go get a loan, but to come up with a down payment, you guys put in personal funds and you run the business together, split profits, that type of thing. There could be one that's just a capital partner that says, hey, I'm going to come in, we're co-founders, right? We're both going to own this business, but I'm bringing the capital and you're going to operate it. And that's how we divide duties, okay? So partners is another way to go, obviously leveraging people. And then investors is the last one, of course. We've talked about this in detail, but you can get people to invest in your business. Now, it's probably easier to get investors in your business when there's a business that's already existing, right? When you're buying a current one that's operating, driving revenue. Harder to get investor money with a concept or an idea for a startup. And so you can definitely go out and get investor money. Depends on the type of business, might depend on the type of money that you raise. If you anticipate scaling and raising a lot of money, then you might get angel investors, or you might go to venture capital firms and start scaling that way. You could also use people that you know. Say, hey, you want to invest in my business? Family members or friends or people around you that, hey, yeah, I believe in you. I believe in this business. I want to invest some money. And you can also use your network. Crowdfunding has become a very viable option to raise money to go out and buy. There are legal ways to do that, of course. It's all regulated. And so you have to make sure that you're doing it in the completely compliant way. But you can raise money to go out and make a business acquisition. So there are a number of other ways that you could do this, but these are the main ones that we're going to address in this video, and we'll go ahead and wrap it there.
Understand the financing before buying the business.